Good day, fellow investors. Here are 4 of your suggestions, so let's go one by one and look at these stocks. So at the moment there are headwinds for food companies, so we'll look at a few of them, and let's immediately start with Mondelez, traded on the Nasdaq, dividend yield 3.3%, P/E ratio below 20, market cap of 75 billion. And when it comes to the stock, many see this. Whenever a stock crashes 25%, good dividend payer, then I always get a lot of questions. So let's look at Mondelez and look at the net income and compare that value creation over time with the market capitalization of 75 billion. We have the P ratio for that. Let's look a little bit deeper. And yes, there is a loss on sale of investments. There is an asset write-down, that's $1 billion. So we have to add here for the last 12 months $1 billion. So let's say 5 billion. And then we immediately adjust because 5 billion is more like a P ratio of 15. Then that allows for good coverage on the dividend. So always check a little bit deeper on the net income statement. Let's go into the results. If we look at growth, there was growth this quarter, there is growth year to date. Volume mix down, price up, that means that there is growth thanks to inflation, but robust cash flow generation, 2.5 billion year to date. Likely, if I extrapolate for the whole year, there will be around 3.5 billion in free cash flows that they use for the good dividends, and they also do on top of that repurchases. So when you look at things here, free cash flow 3.7 billion for the last 12 months, that then goes into dividends, then goes into repurchases, and likely then is spent over at some acquisitions and things like that. If I compare this to the market capitalization, the free cash flows are a little bit lower, so there are significant investments to keep the sales there. It's not that easy when things come to these big companies. Also, I want to show you this chart that shows 20 more years of Mondelez. Revenues have been flat for the 20 years, and the free cash flows really didn't grow for 20 years. So 20 years of flatness is something very important to look at when it comes to investing, because the key thing with this is that the environment is highly competitive, and that's something we'll discuss more. Let's look at our intrinsic value table that we discussed in a recent video, and here is Mondelez. We click and then we get to the valuation there. What can we take as valuation? I have put already free cash flow per share. They have a dividend payout ratio of around 60%. That's the present value of the paying dividends. And then they have been flat over the last 2 decades, but we can start with a growth rate of, let's say, 4% inflation. If I expect a 10% return, then I put a 10% discount rate, and a terminal multiple, we are now at 20. The stock price, the intrinsic value for a 10% return is 42. That's still far from the stock price. Let's see the best case scenario. What is the market pricing in now? 7% growth, a P ratio of 20, but the market is either pricing in faster growth or being happy with a 7%, let's say, discount rate. So 7% likely return going forward from Mondelez if it keeps on growing, but I'm not happy with the 7%. I also want a margin of safety, so if they grow 3% and the terminal multiple goes to 15 for the free cash flow, then the present value margin of safety buy would be somewhere around 32. If we put scenario A 60, 20, 20, the sum is 40 for a likely 10% return. We go back to the comparative table, and Mondelez is giving likely 70% of that, thus 7% return going forward. So nothing wrong with the company, good brands, stable cash flows, long-term stability. It has been stable over the last 20 years, which is not a bad thing, but don't expect more than 5, 6, 7% long-term returns, which is in line with market expected returns, so priced fairly now, but no miracles there. We have also discussed Pepsi, but when it comes to Mondelez on the quadrant, I think there is also risk because there is a highly competitive environment now. So if I look at the lower dividend, if interest rates go up, then dividend yields also go up, and that means the stock goes down. So I have put it here on a risky comparison to the, let's say, rest of the world, not for me simply. Another requirement, Pfizer. So yes, there are headwinds, but in line also with Coca-Cola there, with Pepsi that we just discussed in a video. Let's go to Pfizer. P ratio 36, and like Mondelez, the stock is down significantly, more than 50% since the peak in 2022, and many ask, okay, what to do now? However, if you look at the longer term chart, boom, bust, boom, mostly lack of pandemic, and now we are then reverting again to the mean. Looked a little bit at what they are working on, and they want to improve research and development. That means that there is a lot of competition. Expand margin, that means that is a lot of competition. Achieve commercial excellence, that means there is a lot of competition. And optimize capital allocation also means there is a lot of competition. So when it comes to guidance, mostly flattish, always adjusted. That's crazy with pharma companies. Like we have seen with Mondelez, here you have to adjust it to lower, not to higher, because they already do it here. So we have to check the real earnings. And with pharma companies, it's usually recurring costs that they always adjust for. But that's something different. Then we have regulation, negative impacts, and then we have assumptions, vaccination, this and that, very competitive environment. And it is mostly a bet because you never know which one of these will deliver the next billions and which will not. They then go out and buy new companies, spend huge amounts of money to try to keep their position because their R&D didn't work as well. So spending, acquiring Sagan and things like that. Anyway, look at acquisitions, 18 billion, 10 billion, 22, 43, 43. Then if we go more in the past, 43 billion also in 2009. And when you compare 10 billion free cash flows, boom, pandemic, when all these cash flows expire, we are back to here, and now it is a bet again whether we'll go up or down. And I wanted to do this on Pfizer because I just wanted to discuss pharma companies. For me, I don't know, and I think it's very hard to know. You really need to be a serial pharma investor to invest in these things, to know which one will get the right drug that miraculously lose you weight or things like that. So that's why I don't do pharma, too hard pile for me, but I wanted to do this video so whenever someone asks me again, here it is. Let's go to something more interesting. Michael on my research platform here asks for General Mills. Cheaper, P ratio of 12, higher dividend yield, and let's look a little bit at the investor relation. Keep in mind, this is not food, this is brands. And probably you know some of these brands, I don't know, Cheerios, Häagen-Dazs, and things like that. And that's how they try to market what they are doing. There is a difference between food and brands. Stable business, revising guidance to reflect increased investment to drive volume. More spending, more marketing, lower prices perhaps, to drive volume and market share gains. It is a highly competitive environment and everyone is competing, Coca-Cola, Mondelez, everyone is competing and going for that customer dollar. Share repurchases, 3% reduction, okay, 2% dividend, 5% return, the rest is going then into marketing, potential growth, or just keeping sales flat because they have flat sales, profit also flat, okay, free cash flow conversion, good. So operating cash flow 1.7 first half of the year, so we'll likely surpass 3 billion. When we compare that to the market cap, that's a free cash flow yield of 10, not bad, but not stellar, especially as there is no growth. If I look again at the cash flows over the last 5 years, flat, which means it is a highly competitive advantage, 4% yield, likely no growth as the buybacks cover up for the decline in sales, so that's a 4% long-term return because there are no competitive advantages. That's it. And high competition, everyone investing in sales, things like that, chasing that growth. As everyone's sales are down this year, it gets even worse. So we have Adobe here, many requests. So let me just show you another perspective for Adobe. People see that it is down, but then you have to also look at the long-term trend. This was again like Pfizer pandemic boom. Where are we on the long-term trend? Is it like this? Is it like this and now it's cheap? Or it is a little bit more conservative? If we look at the growth rates, those growth rates were 20-ish rate, and then the pandemic reverted, and now we are more to a normal 10% growth rates going forward. The key risk is simply a recession, simply less demand for these things. Here we have again a great generally accepted accounting principles net income and adjusted earnings per share. Adobe says that their earnings are for this year, let's say 18. One of taxes, okay, that's not bad, and then they start adding or subtracting for there to get to the real earnings of 14. That is a 25, that's a 30% difference on earnings between what they say are earnings and what are real earnings. Because if you spend 30% of your net income on stock-based compensation and then use that money to buy back those stocks, that's a cost. So this is completely wrong, completely misguiding, I would say it even accounting fraud. But okay, that's the law, that's how they present themselves. Net income has been flat relatively for the last years, 5 billion, and let me just go here to an empty sheet of our intrinsic value calculation to discuss how would Adobe look like here. So just as an example, we have net income, it was 5 billion, and so what is priced in the market? We have 0% dividend on 5 billion. If they grow at 10%, and I expect a 10% return, terminal multiple of 30, then the stock price is 136 now for a 10% return. So let's compare Adobe to the market cap. Let's put here in net income at 5 billion, and then let's say 10% growth rates, 30% terminal multiple. You can check the intrinsic value in the link in the description below. Then the intrinsic value is 136 billion, still below the current market capitalization. If we increase the growth, let's say to 15% in the next 5 years and then to 10%, this is what is priced in the market by the market now. If I put a recession here and there, let's say 7% growth and then stabilization on competition, this or that, a P ratio of 20, then you are in for a decline of 60-70%. So I just wanted to discuss here to show how the intrinsic value template can be used to assess what is priced in the market, in this case with Adobe. So I hope you enjoyed this video. Let me know in the suggestions what else could I look at. I still have a few of your comments that are interesting to look at, but that we'll do in a different video. Thanks for watching. I'll see you in the next one.